Welcome to the Acquisition Collective podcast. I am your host, Charlie Tanner. Thank you for tuning in. This is the place where we discuss all things around the M&A landscape. So if that sounds like it's up your street, then stay tuned and let's dive into this week's guest. Thank you for coming today. It's a pleasure. You are number one and number one of many. Obviously, this podcast is for people all around the acquisition space, professionals around it, people inside it, and it's aimed at aspiring people who want to ask questions but don't have the time to do so. So I'm here to leverage my network, my professional network, to do just that. So we have Gary Lennon with us today, and I have known Gary for about 6 months now through our in-person events, and I thought he would be a really good guest to come and showcase startup loans is what he specialises in and how he can help people go from employment to founders the correct way rather than the silly way. But thank you again for coming, Gary. It's a pleasure.
Thank you.
So if you could tell the listeners and viewers that we may have tell us all about Gary.
Okay, thank you very much, Charlie. So yes, we've got to know each other over the past 6 months because you were bold enough to set up the Acquisition Collective and put on an event. And what that was is it was drawn to me because it was set out to be about helping people to uncover more about mergers and acquisitions, how they could get them going, what kind of people might come to those for the people that are doing them, the people that are advising on them, the people that are curious about them.
Yeah.
So I'm kind of like in that space myself where we've helped people to do acquisitions. Mm-hmm. We're looking to do our own acquisitions. We're in the early stages of doing those. And also it's great to always keep learning from other people that have done a bit more than you. Yeah. So I'm really pleased about that. So I'm a co-owner of a company called BIZ Britain and Finance. We started life as a startup warehouse delivery partner. So what does that mean? Well, the government 13 years ago decided they were going to help young people to start businesses with a little bit of finance. And it was set up just to help those people that had an idea, they really wanted to do something, but they just didn't have enough money to just do that first bit. So we got involved for that purpose. So it's about helping people. So my background is not in finance. So my background's not in acquisitions. So in finance, I got into it by default in the sense of I was helping people start businesses.
That's right, yeah.
Mentoring and coaching and consulting and helping people one-to-one or helping people in groups, helping people to learn about being entrepreneurial. And then coming to finance because then we've got to help the people that had previously been told no.
Yeah.
One of the biggest aspects of people gaining finance, especially UK, is they find it hard. They don't know who to turn to. The people they expect to give the finance, like the banks, keep saying no, especially if it's your first time doing anything.
They don't like it, do they?
So over the time, we've helped lots and lots of people do startups in startup loans. And we've migrated and grown, and we've got grown up in what we do. So we're FCA licensed, which means that we act in a specific way. Regulated, and it helps people to understand they're going to be treated fairly, they're going to be treated appropriately. And we've grown into that from there, helping people to start, grow, and buy businesses. So in the buying of businesses, we've helped a lot of companies and individuals either doing it for the first time or they're doing it for second, third, fourth, whatever time. And what they really lack is either the connections to the correct lenders or the knowledge on how to get the money.
Yeah. It's good though. Look, startup loans was where it originated. So then it went into acquisition lending off of the back of that.
Yes.
What did you think? What's the main difference between the two? Is it just bigger numbers, bigger panels, or smaller panels probably with the acquisition loans? When it comes to someone coming to you, what is it they need?
Yeah, that's a great question.
Prior. Yeah.
It's a great question, Charlie. I think the thing is somebody's starting a business, they tend to be doing it from a personal perspective.
Yeah.
I want to do this because, and the because could be, I don't like working for my boss. I've always wanted to do something like this. I've found an opportunity and I think it's the best thing I've ever seen.
Yeah.
I would like the freedom to have more money, to do more things in my life and for the people around me. So that's why people tend to start businesses. Whereas, so what they're looking to do is they're looking to get support, something to give them a bit of a reflection back in the mirror and going, keep going, you're doing the right thing. It's not going to be easy. It's okay to do it.
It's like you said there. I think when people, like, because you get a lot of people coming from the employment space going out on their first, maybe second, third attempt, and then they think, well, I'm going to do it properly. I'm going to get a professional term, get finance and set up correctly. That's probably quite rewarding in itself, just to help someone do that. And the fact is, you can do that. It's
it's
pretty good to look at. I think it's
is.
not one of them jobs where you just provide a service, get paid, and go home at the end of the day. You actually help a lot of people. And
it is. It's thoroughly rewarding, and to have started, there were just three of us that started that business, and we both come from, not both, all three of us have come from a background of helping people, and in different ways, but mostly centered around helping young people at the time. And that chance to be able to say to somebody, you have got your money,
that's it, yeah.
and that feeling that they express, and you just think, well, what you've done is you've helped to change, in a small way, to be fair, to start off with, you've helped to change their life. So you get a chance for them to go and
you think you're giving someone the ability to go and change their whole background, their future.
Yeah.
So it's good, you know. I mean,
it is.
There's not a lot of companies like yourself who do it, I think, with morals. Like, they just do it for sheer profit, you know. They don't care about helping them beforehand, which is, I know you do that anyway. Obviously, you help them do the business plans and obviously the model for it, and then the post side, obviously, you keep tabs and make sure they're on the correct path. So it's not like you're just arranging a loan and then just leave them to their own devices. You do
there's
both sides of it, which is good.
There's quite a lot of investment of effort into each individual case. Now, we've grown from 3 people, we're now over 20 people over that period of time we've been involved. And it's each person is dealing with one-to-one. There's probably 3 people involved in each application.
Okay, yeah, that's good.
There's somebody helping at the start just to make sure everything's correct.
Yeah.
So are they the right person in the right room? Should we be helping them? The second one is really going to help them to make sure that they're credible, the loan is affordable, really important, the loan is affordable, and they've got options, so they've got a plan B, these kinds of things. And then the final person is basically making it more compliant, making sure everything is done in the appropriate way.
Yeah.
So they are protected as the applicant and as the borrower, but also that we've done right by the lender and we've done right by ourselves as well, just to make sure we're all doing things to the values. So it's a very noble thing sometimes, is that you're facilitating money and you're getting paid at the end of it. But one of the things which I really was drawn to startup loans originally is you get paid a fixed fee. So the amount of money that you help to facilitate is not linked to your payment.
Oh, right, I see.
So that means
it's just each transaction is X amount. Yeah.
Yeah. So what you're doing is you're making sure it's the right amount of money.
Yeah.
So sometimes when people are in finance or people are looking outside of finance, they're saying, you just want to encourage me to borrow more because you make more money.
That's it. Yeah. They're incentivized to, to make you over leverage yourself when you're not. Yeah.
No, it's the opposite, in fact. And over the years, the startup loans product has changed in different ways you can use it. But it's always been consistent in that you have support on the way in. So it's finance with support. So support on the way in. And then when the loan has been distributed, then there is a year's worth of mentoring, which originally we used to do, but now it's done by a separate entity. And what that means is that the great thing about the startup loans program, I'm an advocate of it, as you can tell, is that the startup loans program has a much higher success rate of people staying in business than any other type of startup loan. Any other type of startup life. So, for example, depends on who you listen to. Some people say 80% of businesses fail in the first 5 years.
There's that big figure,
Yeah, well, actually, I think that
I'm still yet to be told where it actually comes from.
Yeah, I know. I think it's somebody's made it up, and it's a bit like you have to walk 10,000 steps a day to stay alive.
Yeah,
you know. Who made that up? Well, the people that measure the steps.
Yeah.
Funny enough. So the thing is with that is that I think the measure recently that I've seen is that 63% of people who've had a startup loan are still in business after 5 years.
That's good.
Which is quite impressive, considering the failure rate that apparently is all around.
Yeah.
And one thing I really think is important is that startup loans are there to give you an opportunity. It's not a guarantee of success, but it's also lots of people take startup loans for one business. They try it out. That doesn't quite work.
Yeah.
They can't get another startup loan, but they've now got the taste and flavour of working for themselves.
Yeah.
And they go off to do other things.
That's good, Dave. So if just because you said that, if a person it goes terribly wrong, say they borrowed 15 grand and it went terribly wrong within 2 years and they couldn't afford to pay back the loan, what happens to that?
Okay. Well, officially, people are given money as they're a personal loan for business use. So they're not given, they're facilitated a loan. And if they were taking a loan of £15,000, they couldn't pay back after 2 years. Ultimately, the lender will say to you, look, let's see how you can pay this back. Now, on the one sense why is that important? Well, everybody who pays the money back is effectively giving somebody else the opportunity to borrow that money again.
Also, it goes back into the pot and gets lent out to other people.
Absolutely.
So that's good.
Over the startup loans period from its inception at today's level, and they've done over 120,000 loans. They've done over 1.2 billion in lending, which is a lot of money, and that's all taxpayer money. So there's an element of it. We want everybody to pay the money back. I'm going to come back to your point, but we want people to pay the money back so somebody else gets a chance to use it. Yeah. And we're all taxpayers, and it's his taxpayers' money.
Gotcha.
But what happens in facts? We certainly want to encourage people to borrow when they can't afford it, and we certainly want to encourage people not to pay it back.
Yeah.
But in essence, it's a lot more likely that it would not be treated with any ruthlessness, and there will not be heavy-handed approaches to it. There will not be CCJs. There will not be... You might see missed payments because it's on your personal credit file.
Yeah.
So if you value your personal credit profile, pay it back.
Yeah. You
will not see CCJs against it. People are not going to be forced into debt management plans. They're not going to be forced into having bailiffs coming knocking on the door for a small amount of money. It just won't happen. So the truth of the matter is it's a lot less likely to turn into something that would become stressful.
What's the range of the lend you can?
So for startup loans, you can have up to 4 business owners. So they could be partners or shareholders, depending on the structure of the business. And they can borrow up to a maximum of 25,000 each.
Oh, each. Okay.
So we do, it's not every day, but we do see businesses where there are those types of people borrowing up to £100,000 collectively.
Yeah.
And that works out well, especially if they've got other things around them. And it's not just...
Do they have to give PGs and collateral?
No, they don't. So it's a really good point about PGs and personal loans. So in commercial finance, business to business, people talk about PGs, personal guarantees.
Yeah, always. Yeah.
In personal loans, these are actually private consumer loans. So people tend to use them when they're buying things like cars, or maybe they go and have
I understand.
Something for furniture, for example. So a personal loan is you are responsible. You personally are responsible. PG is I will back it. I'm personally guaranteeing that if the business doesn't pay it, I will in the future.
Okay.
But the lenders are always looking for the business to recover the debt, to pay the money back.
Yeah.
So they want to exhaust all possibilities of the business paying.
Yeah, because that's what I was in my head. I'm thinking, so if it's personal for the business, then they don't go to put a charge on the business or anything like that.
No.
No. Okay.
No charge against the business. And one of the little things about startup loans on their own is you start off paying out, the first month is paid out to your personal bank account, but after that, everybody transfers into a business account because they become a business owner.
Yeah.
So it then gets paid out to a business account. So for the accountants listening, obviously that can be treated in a different way because it's now part of a business activity.
Okay. That's good. I like that. That's going to be very helpful.
Well, we've seen, to be fair, we've seen quite a lot of startup loans that are used, which is what we've got us into acquisitions. Startup loans were used to buy businesses. So you're talking about the difference in mindsets of startups and people buying businesses. So people started following the dream. People buying businesses is betting on a winning opportunity, or they're hoping to. So we got into startups. We saw startups used to contribute towards buying businesses or buying things like franchises, proven models, or buying franchises that have been sold on, these kinds of things. And then they started to be used along with other finance. So we started using other finance as well. And that helped us to build an understanding of how to use different types of finance. And then we got into just doing acquisitions with other types of finance.
Yeah.
Okay, so I think that people buying businesses have different expectations. You know, they're either looking for increased wealth or they're looking for freedom. Wealth, money brings freedom and choice. When they buy the business, if it's their first time of buying a business, their expectations of freedom and wealth might change after a relatively short period of time.
I can
but once they've done it a few times, it's different. They're looking at an entirely different concept.
But that's what we was discussing off camera beforehand, is the transition. You got different mindsets at different stages and in life, in business and entrepreneurship. So you have an employee, obviously mindset, and then if you go to a business owner, if you then go to be a founder, you have to transition from an employee to a founder.
Yeah.
And then off of the back of that, you can then go up to another tier, which is an investor.
Yes.
Like you said. And just the mindset shift you need to make to do it productively is huge in itself. Yeah. It took me two rubbish attempts at acquisitions to learn that the hard way. But that's just me and my style of learning lessons. I have to learn lessons the hard way. Although I can read books on it, theories on it, I can be told it directly in my face from people who are 2 decades in front of me. I will still do it my way, thinking I'm correct, and I'll learn the hard way. But that's just me.
No, I don't think that's just you, Charlie.
No.
So, I think most people that buy a business already think that they are successful as a business owner, even if they're not. So they've got their preconceived ideas. I know what I'm going to do. It's my rules. Yes. I'm going to make sure everybody understands who the boss is. So that kind of approach.
It's quite funny. So today I've bought 6 businesses, all in the construction space, right? So it's all in the space where everyone advises you not to go because it's the high risk. But before my acquisitions, I'd come from construction project management, then I went into property development, and then I went into acquisitions from that. So it's been a very different journey from your usual business owner. You know, like I've always sort of just got on with something and wangled my way through. So I've always just attempted it, and my first year has been really poor, whereas I've gone into businesses, tried to make all the changes within the first 2 months, and everyone hate me, you know. Yeah. Whereas I've then done what I do now is when I do acquire, I sit back for a quarter and just observe, you know, because 2 times I've tried doing it before and being very forceful and trying to change everything within a quarter or 2. People are very rigid who have been in establishments for a decade or more.
Yeah.
So
absolutely.
Yeah, but I learned that the hard way, you know, but I'm glad I learned it the hard way because it's all about, if you want to be successful in business, you've got to be a people person. You've got to understand and make sure the team is on the same page, they are efficient enough, obviously, in itself, and you treat them like human beings, because if you don't, there's no point doing it'll be a failure.
I fully agree with that. And I think it brings back to the mindset of, what people change from being an employee to being maybe self-employed, to being a business owner, to being an investor.
Yeah.
So the different mindset is the employee doesn't get the customers.
No.
Doesn't lose any sleep if they lose the customers.
No.
Doesn't worry too hard about whether they're pleasing the suppliers or not. And they don't have to pay the money out at the end of the day. Whereas somebody goes self-employed, becomes an employee, but with all the stress of getting the customers and getting the money and paying the money out. And I think the business owner it's a different level when you're employing somebody else, because all of a sudden you learn, as another parent, you learn that you've got these children. They may be over the age of 18, and they may be even over the age of 50, but they suddenly become like children where you have to feed them. Yeah. And they kind of like don't know how to do something, but not willing to go and find out. And you have to treat them in such a way that you kind of, the first response in your head is like, why can't they do it? But actually, when you think about it, you think, well, okay, this is what they're expecting, so I have to adapt what I'm doing. So your mind changes over time. Yeah. Is that treating people in an appropriate way, in a fair way, and encouraging them and enabling them, but at the same time holding them to account. Yeah, so that's where a lot of people fall over in business ownership.
There's that fine line right there. Yeah.
They don't hold people to account. And what happens is they start allowing other people to tell them how to do things and how to run the business. Mm-hmm. And yet these people telling them, switch off at 5 o'clock. Yeah. Switch back on at 9 o'clock in the morning, or whatever the term is for their particular business. And the business owner is the one at 5 o'clock takes it with them all the way through the night, all the way through the next day. They've got the stresses, the worries, the payments, the customers kicking off, the complaints, the whatever it is. There's no way in industry, it all happens. And I think the mindset of the business owner starts changing, and they start losing some of their affection for people. But what they do is they see the people in the business as essential to make it happen, and worthwhile looking after them as long as they're looking after the business. So when people get their head around that when they're in business, is if the team's looking after the customers are looking after the business because they're paying the money, and the business is looking after the owner. So the owner can look after the team and the business, making sure that everything's fit and functional and doing things in the right way, but also making sure that the customers are being looked after by the team. Yeah. So I suppose then moving on to the investors, they already know all this, or theoretically they do. But if they do know this, then what they'll do is they'll spot the gaps and the problems quicker. Yeah. And like you, rather than going in there and saying, right, okay, sleeves are coming up, out the way, I'm at the head of the game here, I need to tell you what to do, this is how it's going to work. No, forget what you've already done for the last 10, 15, 20 years. Yeah. We're going to do it my way now. Instead of doing that, they use the intelligence like you've done, and like a lot of people who are buying businesses are doing. And what they're saying is, right, let's find out. Because if I can listen and I can learn, I can adjust only what needs adjusting and keep what is going well. Yeah, that's right. Keep it going on well. And people buy more than one business. If they buy, let's just use simple mathematics. If they buy 10 businesses and all 10 of them have one unique thing, they've now got 10 times 10. So they've got, each one business has got another 9 unique things that it can leverage. May not use them all, but on the whole, it can use a lot of them. So what happens is you get that multiplication factor. That's it. So the likelihood of success is higher. And if one of the businesses falls over,
it's got others to pick it up.
Yeah. So the investor's thinking more of, I've got an asset that's generating income, giving me choices and the freedom I'm looking for, without the stresses of necessarily running the day-to-day business.
Yeah, because when you start looking at acquiring on a group level like that, buy and build, search funders, whatever models they do these days or term they put on it. Yeah, it's all about spread, like you said, when you refer to it as a portfolio, you're just spreading your risk. Yeah. Essentially.
People have been doing this for a long time. in certain environments, so people have been buying shares in companies, and they'll buy shares, even people who are buying, like an ISA for personal reasons. You say, well, I'm going to put my extra cash into something like an ISA. Or they've got savings accounts, but their savings accounts are linked to something else.
Yeah.
Or people are buying one-off company shares. What they're trying to do is they're trying to hedge their bets and just spread the risk around and make sure that they don't put all the money into one effort. Business ownership sometimes is the opposite.
Yeah, it's like you said, if you put all your eggs in one basket, you run the risk of it going, falling out of bed. So,
absolutely.
I mean, so when it comes to looking over your history, because obviously I've done a little deep dive before this chat here today. Obviously, you've started and founded a fair few businesses, even before BIZ Britain. And before that, I think you was in sales and marketing, wasn't you?
That's right, yeah.
So what made you, coming from an employment background, being an employee, go, I've had enough of this, I want to go and do this by myself? What was the trigger in that?
So I'm a little bit older than you, Charlie. You might not be able to tell that, and maybe the camera's flattering, but at the same time, I've gone through different stages of life. Yeah. So when I was young, the internet didn't exist. So for those that have never known anything else but the internet, that's quite a sort of shock. It's like, there was a time before mobile phones and the internet. Wow. And your influences were the people that you met. So that would be people that could be related to you, family, mom, dad kind of thing. It could be kids at school. It could be when you found a job. So I didn't know anything about entrepreneurship, even though my father did own a business. It wasn't something I wanted to do with him. Yeah. And I didn't see going into his business. I just saw this job and thought that was a really exciting job to do. It sounded great at the time, electronics engineer. So I thought, I'm going to be an electronics engineer. So I managed to do that. And I did it in one company, did an apprenticeship. That was quite interesting. Lots of learn new things. So when you're young, really young, and then you learn all these new things to do things, it's really exciting. Because even if it's mundane, day to day, every time you're doing something new, it's just new.
It's like better than school. Yeah.
And what I found out was I like to learn new things. What I also found out is I like to express my opinion. And in my employment career, I can't.
They don't like that.
No, they don't. People don't like you saying we could do this better.
Yeah,
we could do this a bit differently. And I found, as an electronics engineer, I found myself up against this just resistance to change because people wanted to keep things the same because it's what they knew. But I was then meeting, so change of perspective. Mm-hmm. I was meeting sales guys who were coming to sell semiconductors. And they pull up in the car park outside the company, and there's this really nice car. I'm thinking, I like one of those cars. Yeah. And I thought, I can't afford a car on my wages or salary at the time, not to the level of that. Yeah. So I thought, I want to be a salesman. I hadn't got a clue about salesman, and I wasn't really that confident as an individual at the time. So I then went into sales in semiconductors. And that was an experience because you suddenly become, expectations are thrust upon you. You've got to make so many calls a day. You've got to do all these drives. You've got to go and get people to buy stuff. It's like...
sales is a whole different ballgame.
It is.
It's like I say to anyone, in business, that's probably my least skill set, my worst skill set. Me personally.
Okay.
But that's, I think, partly to do with the industries I've come in. I
think there's some. So
once I've established a relationship with someone, it's absolutely fine. But it's just that initial thing. Or businesses that I've acquired, they've always had sales or BDs in them or something like that. So I've never had to do it myself. So like when I was in the early days this was for my first business, I had a residential main contractor. So the gatekeepers of that industry was architects.
Yeah.
So that was building rapport with architects to try and get on future tenders and things like that. It's very much of a slow burn.
It is. So I'm gonna fast forward a little bit. So I went through a number of different sales roles, and including European sales management. So I'd had responsibilities, and I had responsibilities for people and targets and bigger budgets, and in the whatever numbers that people like to talk about, it was across a number of countries and 30 odd people that were responsible to me, or I was responsible for them. And one of the things I would say is that the difference is, so I've come pre-internet, and then grown through with the internet. So sales has changed considerably. And the emphasis in days gone by is people used to go physically out to make a sale, whereas today people are drawn in through marketing efforts and through use of technology. Not only technology, but technology mainly is leveraging everything to come to you, because people search for things on their handset or on their laptop. And what happens is that the emphasis is not so much on sales, but guiding people to buy in a much more beneficial way. So I think the ability to sell is not, maybe to pitch is okay, still there, yes, and especially in things like finance and buying businesses, because you're pitching and negotiating. But actual selling skills have adapted, and they're softer skills as opposed to get on the phone and drive up the motorway and get in there, and you've got to win a battle. Whereas now it's a case of,
I do still like that aspect though. I mean, I'm going through that in a minute. So obviously I've got a business brokerage and advisory firm, and at the moment I've decided to scale it, come in 26, and currently building out the sales team. Right. So I've got 2 guys I'm bringing on at Telesales, and then another guy that starts on Monday, believe it or not, who's doing. He comes from an accounting background. Right? He does direct BD essentially. So that's the sort of mix I'm taking. But that's because I want to do that approach, and I want it to be. It might be a slow burn at first, but because it's a 5-year projection that I'm going for, and the sales team will build out underneath this team. I want real relationships to be built now, good foundations to be set for future, for it to grow better.
I think relationship management. So there's hunters and gatherers.
Yeah, I was just about to get on to that.
So the hunters and gatherers. So the hunters, that mindset is absolutely essential to get new customers.
Because people say like a BD salesman, and then you need an account manager. They're 2 different skill sets that they have. Like you said, one goes out and attacks, or wrong term. One goes out and brings the work in, and the other just manages the relationship throughout.
Sees opportunities. Helps to improve profitability. Choose the right services and solutions. But I think the hunter side, and I'm not against the sales mantras. I'm not against the sale. It's not about being against, but I'm not saying we shouldn't lose sight of sales is important, because nothing in a business starts without a sale.
Correct.
Getting to the sale and using the people and how you get to that sale, and the opportunities is that if your marketing is accurate and you profile what your best customers look like, you're more likely to get the sales, because you only talk to the people that are worthwhile. Historically, salespeople kind of like picking up the phone and ringing anybody, and they had no idea who they were. Whereas now, like you said, you did a little bit of research and you found out I've done a bit of this and that. Today, you can find out, with a bit of will, you can find out a lot about people if they've got an online footprint. And you can also establish a lot of information really quickly using the technology we have available to us today. And you could write a book about somebody within a short space of time. In minutes, I'm not saying good, but it's true. Excel. I know lots about you, so
it doesn't take long, like you said, to factor in not a good pitch to someone, but to go the extra mile. And do that bit of work. And that's what I think. Even a lot of these agencies and stuff who work on behalf of people, they don't do. They just generate lists and do lead gen.
Yes. It's a moot point, lead gen in any industry.
And I don't quite like pay-per lead and pay-per-click and all this stuff. There's no real heart in it, and you got to think, it depends what your long-term view is for that business that you have. If you want real long-term relationships with people, I don't think things like that beneficial?
Yeah, I would say up to a point. I agree with you. I think it depends on whether
It depends if it's B2B or B2C.
Yes. So I was going to say if it's transactional or if it's relationship.
Yeah.
So if people are spending £10, get somebody to ring them up for £10.
Yeah.
You really need to
That's
employ
probably
somebody that's only earning £1 to make that call.
Yeah.
Yeah. Because otherwise it's expensive.
Yep.
If it's somebody buying something that's £100,000, and that £100,000 is not just in one transaction, like a property, for example. I know it's not 100,000 in certain circumstances, but if people are doing £100,000, and it might happen over a period of a year, like a contract, or it might be longer than that. It might be buying something and then providing a service attached to it. Yeah. That's more of a relationship sale. That needs definitely somebody who can speak to people and hopefully can influence people to make a decision towards the outcome that we as business owners want them to do. I think when it comes to even bigger contracts, that's like a group, a pack mentality. You have to look at it, a key account approach where you're talking at different levels and you're finding out all the levers and the pushes. Don't get me wrong, if it's all about a tender, doesn't matter how good your sales pitch is, if you don't meet all the key attributes on a tender, you're dead in the water. Yeah. So I think there's some elements for that. So for me, having the grounding in sales and knowing how not to sell, I'm being very good at not being able to sell in the years I was doing selling until I suddenly found my way and thought, on the whole, buyers are people, and you kind of like build relationships with the buyers, and it depends on how your character is and how their character is, whether you connect or you don't. But if you learn how to adapt around there, then it can be quite fruitful, because what you're doing is you're helping them to do the right thing for their company, for example. Whereas buying to consume, B2C, buying to consumers, on the whole, I'm selling to you personally, so I've got to convince you in the space of time I've got with you to make a decision to me. Whereas in business to business, there may be a whole bunch of quotes and there may be a whole number of measures that need to take place beforehand.
80% of my businesses are all B2B, so the B2C sector is I don't have experience in it, so it's a whole. I can imagine it's a whole different animal in comparison.
Well, everyone's a quality controller as a consumer, aren't they? If you've had you've hired a cleaner to come and clean your house, all of a sudden they come in and the next thing you know, you're now a quality inspector. Yeah. Because you'll go around the house, you give them 2 hours to clean a 4-bedroom house. And you expect them to be absolutely brilliant, 100%, floor to ceiling, everything, nothing missed. You go around going, there's a bit of dust there, I missed that. And you're thinking, well, is that really fair? But it is, whereas I suppose in business, it's a little bit more relationship-led over a longer period. People don't always pay up front, they might pay on terms. So there's a vested interest on both sides to get it right. Yeah. Whereas in business to consumer, everyone's kind of like, well, I need it 100%.
Need it now,
Yeah, absolutely.
I would probably say B2C is probably more difficult. 1, to actually land the client, and then 2, to make sure that the service is received well.
It can be, because
a lot more attention to care.
Yes, there is. I mean, people today are drawn into getting reviews. Yeah. So they want to get reviews. What do they want to get a review for? First of all, they want reviews so they can show other people they've got customers. And then when they do it long enough, they want a volume of reviews to show that they've got consistency and their performance is not just in one short period of time. Mm-hmm. And then as they're going on from there, they're using that to leverage to get bigger customers. Yeah. And then they'd start doing bigger jobs or bigger services selling bigger amounts of value per item if they're selling products, for example. But in services, it's all about what the feedback was on how you did it. So it is a different mindset in consumers for sure.
Yeah, I don't think I could work in sales. Not full time. Not full time at all.
I think but do you know what? In sales and business, some people are better salespeople than they realise.
Yeah. I've been told that as well. So.
Yeah, and what they don't realise is that sales is an opportunity with a purpose. So I want to get something done. I want to close the deal. I want to get it done by this month because.
Yeah.
So salespeople are driven by time and by volume or value, however you talk about it. Whereas in business, it might be, I've got a longer term aim, so I'm willing to not try and close every deal at the point of contact.
Yeah, because they think, it's what a lot of youngster sales guys I've talked to, they think they should be closing like first time.
Yeah.
And it's a bit like, well, you got to warm someone up a bit. It's like, I've had plenty of telesales people ring me up, and I've never been told anything over the phone. It's just not for me.
Yeah.
They've introed and set appointments. Yeah, that's a different thing. But I've never been directly sold over the phone.
Yeah,
but that's because I come from the era of scams.
Yeah.
So and that's still going to this day.
It does. Yeah. And when people call me up and say, "Hi, Mr. Gary," I'm really going, "Okay, we're off to a bad start already."
Yeah, that's it.
You know, and it's not because they're from a different country, different culture. It's because they're already trying to elevate.
They've got the wrong data in front of them to shoot properly.
Yeah, but they're also trying to elevate me. No, they're trying to say, "Look, I'm showing you due respect." It's like, not really. What you're doing is you're coming across as kind of like saying, I am elevating you. Hi, Mister. And it's like, no. If you know who I am, if you want to call me Gary, that's fine.
Yeah.
If we have agreement that that's okay, because you might need to call me Mr. Lennon in some circumstances. Yeah. But it's a case of if people are engaged on the phone. I think telesales. I know we're going to go more into AI agents and voice agents. Yeah, even there's nothing wrong with that personally, if you act in the right way, if it's guiding somebody towards something.
Yeah.
But I think over the phone, if you can't get face to face, and not everything needs to be face to face, but if you or do things like online meetings, then over the phone, I think it's a great way for people to listen to the tonality.
Yeah.
You cannot see body language over a telephone, but you can hear it.
Yeah, but it's all about tone, like you said. It's all about how the voice is. And that's why, like, for the brokerage that I have, it's my two main clients is directly business owners, because I want to see if they want to sell, if they want advisory, ongoing advice. And then the other people that help we go through to get to them is accountants and wealth managers.
Yeah.
Right? That's pretty much it. So that's why my sales guys have accountant background. And then the other telesales guys, I only brought them on because actually they're two brothers. They got very nice phone tones.
Yeah.
And then that helps because I know that the business owners that I sell their business for, they're majority of the time 45 or older.
Yeah.
Right? And they come from telesales era and they prefer speaking on the phone rather than the whole LinkedIn outreach stuff and emails. They don't like that rubbish. They like to be spoken to, and then they like direct letters to them, like a mix. That's the best sort of result I get.
I get that, and it makes a lot of sense, especially in a business where what you're trying to do is engage people who are busy.
Yeah,
interrupting somebody.
Yeah,
but with some professionalism, some empathy.
Yeah.
And with some purpose and some vested interest in this conversation, you're looking to help them to move on to that next stage in their life at some point, either now or in the future.
Yeah.
So telesales is absolutely essential for building rapport and just getting them to go, okay, it may not be the right time, but I'm listening. And it's that connection with people.
Yeah, that's exactly it. And these two chaps I use or will be using, they're like in their 40s, so they know they've come up doing this and they've been doing it for like maybe 2 decades. So yeah, I'm very excited for them to get going.
Yeah, well the thing is, if they've been doing it for 2 decades, they're probably unflappable.
Hope so.
They've heard every piece of language that you can imagine.
Yeah.
They know that people can get upset and frustrated because they've been interrupted, because everybody's interrupted with a phone call, unless you've got pre-agreed appointments. That's a really powerful tool in sales, is if you can get somebody to agree to an appointment, if you can get them to book an appointment with you, which is great when people have their own calendar links, it's really helpful.
Yeah.
And if you can get somebody to book an appointment, maybe sending them a text and saying, book here, because we'd like to speak, you've agreed to, marketing has drawn them in, maybe they've looked at the form and they clicked a button saying, yes, I'd like to have a conversation, and then through means of technology or even just picking up the phone, it's not an interruption they weren't expecting.
No, and and they feel in control because it's on their terms.
Absolutely.
As well. So it's not like a pressure point, whereas before, like, calendar links were a thing and all of that, the appointment setters, it was like, when you're going to book an appointment with him, obviously you get PAs doing calls and stuff and whatnot.
Yeah.
How about next Tuesday at 4? Oh, no, it does well. And then it becomes a back and forth.
Yeah.
And then all of a sudden they're like, no, I don't want to do it. And then you lose it. Whereas if you just give them that link, it can be seen as lazy, but then also it can be seen as convenient.
Mutual convenience.
Yeah.
So I'm a big fan of saying to people, if they want to have a meeting with me, is if it's an online meeting, it's like, well, if you don't have a calendar link, I don't provide one, tell me some availability. Yeah. And then, right, we'll choose that. So you send me a calendar invite using your preferred online platform, because that way
you're in the driving seat.
Well, that means
you feel comfortable.
The other person's got the choice of when it's happening.
Yeah.
And also they're doing it to their convenience, and they're also using the current technology that they prefer. Yeah. Which can be a pain because, as we know, in the various different guises of using different online platforms, some of them start really quick, and some of them you feel like you have to write it.
Yeah, it's like I was literally yesterday, I had a call with a potential client, like a business owner who's looking to sell, and this chap was him and his wife on a Zoom. 5 minutes after we should have met on the Zoom, just give him a quick call. Hi, are you coming on? Oh yeah, we're just trying to get online. My daughter's coming down just to get us online, sort of thing. It's like, because not everyone can do it.
No, and also some systems, despite the fact that these systems owners have been going for 40 plus years, they still don't like talking to each other. Yeah, as we all know, the major brands.
Yes,
so that's true.
It's true though. So with BIZ Britain, because I like to keep swinging back to BIZ Britain. So when, obviously, you help people with business plans to get them on the right path. Yeah. So when it comes to business plans, do they have to be massively in depth, or obviously not like a one pager? They probably need more than that. What sort of standard?
I think this
would be acceptable.
If we look at business plans for investment, business plans for finance, slightly different. Mm-hmm. So business plans for investment, all they want high level. Show me everything you need to know in the exec summary, and then break it down with all the finer points that are going to be put into some depth. Yeah. If that business plan is going to be carried to a variety of different people, and they're all going to look at it and look for different aspects to it. Yeah, that's when investment into a business plan should be quite in depth, quite a lot of pages, high level of intelligence, and also respect for the people looking to make the investment. When it comes to debt finance, anybody that is working in finance and debt finance, and then knowing you're going to go and talk to a bank, or you're going to talk to a lender, whether it's an alternative finance lender or whoever it is, doesn't really matter. When somebody in that organisation is looking at a business plan, they go, if there is an executive summary, they'll look at it and I want to get a feel. Yeah. Okay. What they want to know is about the team that's there and is going to be there after the transaction. For example, if it's an acquisition, they want to know the industry. Is the industry growing, shrinking? Is it going faster or slower? These kinds of big macro things. But they're going on to a lot of detail. And today they can find out themselves a lot faster.
Yeah, I was going to say,
you can write it. Yeah. So what they're looking for is they're looking for a business proposition to gain finance. So what they want to do is they'll look at the top end, and dare I say, the next thing they'll do is straight at the financials.
Yeah.
And a lot of people in finance will look at the financials first. So the lenders will look at the financials first to say, is it worth bothering with?
So what do they look at?
Well, there are
What are the go-tos?
the go-tos.
Yeah.
Well, if people understand what financial documents are, and you've got three documents. You've got your income statement, or called profit and loss. You've got your balance sheet, and then you've got cash flow. Profit and loss income statements, for want of a better description, is what comes in, what goes out, and what's left. So that's your profit and loss. Your balance sheet tells you it's a snapshot at that particular point, whether it's this week, last year, or a forecasted balance sheet, what is going to be positioned in terms of what's available in the business to look after what's going out.
Yeah.
So assets over liabilities, these kinds of things. So when lenders look at a business and they say, should we lend towards this business? They're really keen to know there's a positive assets over negative liabilities.
Yeah.
So when people talk about, I like to see a positive balance sheet, it could be £1, or it could be £1 million, or it could be 10 million or more, of course. Yeah. And it's about, and there are different components there. I'm don't really want to go into all the details unless you really want to, but
I'm just skimming it.
Yeah. So so lenders and finance companies are looking at the balance sheet to start with to say, is this business doing okay? Could it be better? Yeah. Yes. But is it doing okay? Yeah. And then they look at all the different measures in there. The next thing they look at will be parts of that balance sheet, because they want to know, is there already some debt in there?
Yeah.
Are they compounding, increasing, or are they lending to the time where there's no other debt in there? Mm-hmm. Because it means that if there's no other debt in there, is it because they've never borrowed money, or because they've paid it off? Okay. If it's to somebody that's already got debt in there, what they want to know is, can the business sustain more debt? And does the business look like the owners, the managers, and the leaders of the business know how to use debt? Yeah. So it's a bit like your own personal credit profile. People go, I've got a great score on one of the credit companies. And you go, great. Do you know why you've got a great credit score? Yeah, because I pay all my bills. Mm. Have you got a mortgage? Yes.
Yeah, if you pay that regularly.
Are you paying it regularly? Yes. Automatically, you've got a better score because you're showing, you can demonstrate, you can maintain debt.
It's like credit. People, it's like, I remember having this conversation with my mum. It's like, yeah, but obviously your credit rating is really good because you have the credit card, mm-hmm. and you're under the 50%, obviously.
Correct, yes.
Under 50%.
Yeah.
And regularly using it and regularly paying it back.
Yes.
Because you get, like you told me, you get your groceries and you get your petrol every month on it, and then you pay it off within 30 days. I mean, that's a really good thing to do.
It is. Young people building up credit.
Yeah.
They should get these first credit facilities for £1,000, £1,200, whatever it is. And what they should do is everything that they paid for with their debit card, now pay for with their credit card. And then at certain points during the month, if you can, pay at least twice.
Oh, really? I didn't know that.
Yeah, absolutely. Because what you're doing is you're
even now, I just do one big fat one after 30 days.
I tend to do two. I have the automated one where it pays off a certain amount. It depends on whether you want to pay off all the credit in one go. If you want to pay it all off in one go, great. But what you can do is because you paid up from one go, there's no interest typically, which is absolutely fine. But if you don't want to pay it all in one go, because maybe you've spread a holiday over it, like 3-4 payments, what you're doing is if you pay up for a little bit or pay off part of it, it's tricking the system to saying that you
do more.
It's a bit like when people want to reduce the term on their mortgage.
Yeah.
Pay your mortgage twice each month. I'm not saying
10%, 10%,
but pay some at one point and then pay the rest at the next point. It's tricking the mortgage to say that you're paying off components of the capital.
If you do that over his lifespan, you can
reduce capital.
8 years.
Sorry, easy. That's could be done over 25 years to 8 years. You could do that. But just on this back to the business and what lenders looking for, what they're looking to do is if you've already shown that you can demonstrate you can pay off debt, they're then still looking in your balance sheet and then looking to say, and they go, well, what kind of debt have you got?
Yeah.
Is it debt to lenders? Is it debt to HMRC? Is it debt to other creditors?
Yeah.
Who are they? They get very suspicious
Yeah.
about those. And then they're looking to see, is it short term, paid within 1 year, or is it long term? So what they're doing is they're looking at, is it positive? Does the business look like it's in a good shape? The next thing they're looking at is the profit and loss.
Yeah.
Because they want to see, is this business, so if they say, for example, we want to see 2 years worth of accounts, is it going up? Is it about the same, plus or minus a few percent, or is it going down?
Yeah.
And what they want to know there is reasons. Why is it going up? Why is it going down?
Yeah.
Why isn't it changing? And there could be a whole bunch of reasons for that.
I think there's more questions to be asked is when it's, like you said, when it's not changing. That's when I look at accounts, just to review, to potentially acquire. Yeah, if stuff doesn't change year on year or is very similar, it's a bit like, what are you hiding? What am I going to go digging for?
Well, this is it. The size of the business matters.
Yeah.
You know, if somebody's doing 100,000 turnover, 1 million, 10 million, or 100 million, 100 million turnover business could have a lot of consequential costs.
Yeah.
That aren't seen in any other type of business. Mm-hmm. Okay, and it could be because they're in different countries. It could be because they've got different types of taxes to pay. It could be that they've got regulatory activities they have to perform, and so on and so forth. So their stability is strong. So that consistency is still seen as good. Yeah. Sometimes they have really small margins. You know, if you look at supermarkets, billions of turnover, 2% margin. Yeah. But what they are is they're very good cash generators because they don't pay the customers very quickly, the suppliers very quickly.
No, they will not.
And the customers pay them up front for the service, for the product. So their business model is very attractive. And even if they only go a fraction of a percent up or down,
it's big, yeah.
It's still big, yeah. Whereas I suppose really in a smaller business, why did you have this turnover this year and the same turnover last year? It could well be that last year you decided to get rid of poor paying customers. Yeah. And this year you got 25% more new customers, but they're better paying. And then you look at the profit margin, you suddenly see, it's up by 3, 4, 5%. And you go, well, that's really good. What did you do to improve the profit? Yeah. And the counter side of that is you could see the change, the profit margin might have gone down. And it could be, then you look into other things like in the balance sheet, you find a bad debt, and you go, what was the cause of that?
People then don't also, like when you see a business that's been growing for, like, say, 3 to 5 years, you don't understand the cost of that. Because they think, the turnover's going up and up, but the margins isn't. It's like, because it costs. You got you got staff costs, you got systems and processes, you got stock, there's all you got all these other costs. Your top line's going up, and you think, but that's gone up 50%. Why isn't the profit gone up 50% as well? It's not as easy as that, because you got a growth cost that people never take into account or understand.
Yeah, I think it's absolutely appropriate to talk about the documents and why they're important to the business plan. The relevance to it is that if somebody then looks at the other third document is the cash flow. So you can see cash flow from a year before. If you look at 2 lots of balance sheets, how much cash was there then? How much cash is there then? Yep. What's the difference? What made that change? Did it go up? Did it go down? These kinds of things. What do they spend money on during the year? Yeah. Which may be hidden in the profit and loss, but it becomes more apparent on the balance sheet. But when you look at cash changes, you go, what are they spending the money on? And actually, there may have been interruptions. So if you've had a legal case, for example, for whatever reason, if you've had a disruption, so your building, you had a flood in a building, these kinds of things can eat away at cash, but they may not happen every year. So they tell a story, and actually it tells the lender, if you can sustain even when things are quite challenging,
you've got good.
You've got a solid business ownership and a solid business because you can weather the storms, which is really important when they're looking at lending money to somebody.
Yep. I've seen that businesses, say they started in the 90s and they're still here today, they've weathered every storm going. So you think, I mean, even now, because obviously when I value businesses, I like to do the previous 3 years approach, to get a fair fair valuation. So, and obviously in the last 2 years before this year, it was really difficult because of COVID.
Yeah.
But now we sort of come out and just on the outside, probably got one more financial year to report, and then obviously you can start averaging it out fairly.
Yeah.
But you can see COVID affected businesses in the wrong way, as they would have, as you know, and everyone understands that. Whereas some went the other way and thrived, because of certain services they provide or whatnot, or they just didn't stop and they could carry on going.
But I think so back to lending companies and business plans. If they can look at those kind of impacts and what did people do and adjust around them. So they're looking at the executive summary. They want to know about the team and they want to know about the financials.
Yeah.
So business plans do not have to be days of effort.
Yeah, some people think they have to be like a 50-page doc.
No, they don't.
Don't get me wrong.
In fact, it's the opposite. They don't want a 50-page doc.
They want like a 5-page.
And if you can provide it electronically, in today's world, what they'll do is they will put that document into a large language model.
Yeah.
And they go, summarise this for me.
Yeah, that's what they do.
And to be fair, as a broker, sometimes if you're looking at an acquisition, for example, as a broker, you're looking at the target business documents and you're looking at the existing business documents if you're judging, A, whether the business owner knows what they're doing.
Yeah.
And if this business is either doing that transaction or maybe a guarantee against the transaction, you're also measuring if we translate this existing business capabilities into this new one, is it going to make it faster or higher, or is it actually going to slow down a little bit?
Yeah.
So what you're doing is you might get, at times, when you add in bank statements, so if you, for example, have 12 months bank statements, well, some businesses only do a few transactions a month, others do hundreds.
Yeah.
So if you imagine, and they might have 3 bank accounts, and they go bank accounts for different things. They might have bank account in different currencies. So if you imagine you have 30 to 40 bank statements in documents, plus accounts, like I said, 2 or 3 years, plus management information, plus forecasts.
Yeah.
Okay,
it's a big exercise in itself.
So
if you used to do it manually.
If you're doing it manually, people used to do it on paper. That's why things used to take so long.
Yeah.
But if you look at that, you put that into a large language model. Okay. What happens is you train it up to look for all the information you're looking for and to put it together as a proposition. And I have to say, and it's not a secret, so I'm not the only person who does this, but I send information over to lenders. It probably takes me about an hour now, but it's written lender ready in the language they're looking for, and I get more positive feedback from my proposals than I do from the feedback from somebody getting their finance.
Yeah, but it's efficient though, isn't it? Like you said, you've moulded it to the way that you think, so it's just
but it's also
applying your mindset to it.
It's applying the lender with the information they need succinctly.
Yeah.
Looking at all the pressure points and testings and paying attention to what's important to them. So what you do is you're making their life a lot easier.
Yeah. Because
when they pick up that package of information, what they tend to do is they top and tail it a little bit.
Right. Okay. Yeah.
So they make it a bit more about them.
Yeah.
I did this, but they'll probably put it into another one.
Yeah.
With their other
products
and documents they need to use.
Yeah.
And then they'll put it all together and put it either to their manager, depending on the circumstances, their manager or their underwriting committee, or their underwriters, depending on the size of the organisation. And what it's the game, but the game is it has to be accurate, it has to be relevant, and it has to be consistent.
Yeah.
So if you're telling the big story on one side, and then you look at the numbers and go, no, it doesn't look like that. Immediately, your credibility is shot. So you have to know what you're talking about, even if you use the technology to do what you want it to do.
Yeah.
But the beauty of that is that if you bridge that into getting customers, and you're looking to do customers, you can say with some gravitas that I'll make sure that the lender gets it in the language they're looking for, and I will choose the lender that meets the criteria, because you can do the research on the criteria.
Yeah.
And I did an exercise a little while ago to say, find me 100 lenders in the UK that will do MBIs.
Yes.
Most people in acquisitions at the moment are MBIs. It's not always been the case. For their first acquisition, they're buying somebody else's business. They may or may not be a business owner.
Yeah.
Another point.
Good model though. I think.
Yeah. So I did that, and I got 100 lenders in the UK, and I got it to give me all the criteria, including how they do their assessments, including what documents they require, the minimum maximum lens, the ratios of information that they require in terms of serviceability.
Streamline the search.
And I produced that in
minutes.
A few more minutes, but but it was going back in there and going back and saying, okay, so far I believe you, but I'm not quite sure you're entirely accurate.
Right.
These systems they don't always tell the truth. And if they don't know the truth, they'll make it up. So you have to be a bit more, savvy about it.
Yeah, you have to be very specific.
Yeah, you do. So what I'm getting to is that the beauty of using tools and looking at business plans is, if giving advice to anybody, don't think the business plan is there just to create for you to leave it. You're better having a strategic plan on one page, strategic document. This is my one pager.
Yeah.
And then behind it, because you can take that to a lender, and that's my strategic plan, and then saying, here's the financial documents I've gained from either my business or another business, and here's the forecasts once I get the money and what it'll look like going into the future. That's more around acquisitions.
Yeah, that's right.
Growth finance, I'm lending to you, your business. I'm a lender, you're the borrower. It's all about your business. So you just tell me a bit about you and your business, because I can look at the financial documents that you provide. And if I'm your bank, I can look into your banking, or if I'm a lender that says, give me open access to your accounts, I don't even need your financial documents. I'll just look into the details and go, what can you afford?
Yeah. And so with growth finance, not a lot of owners actually know about growth finance, how easily accessible it is from my experience. And what they don't like is they don't like the debt itself. That's their main issue with it all. As you know, we keep talking about this. Yeah, a lot of business owners don't like debt. They think it's a horror word, you know. But growth finance, so to get growth finance, you just have to provide the access to like 3 months worth of accounts, don't you? And then the simple 3 docs you've gone over to get the ball moving. Yeah. And then from that, they will say you can borrow up to this.
Yeah. I think just to address the first point about people not liking debt, and it's a really moot point, because the consideration is depending on the background of the person, what age they are, what upbringing they have, where they've come from, what exposure they've had to risk with finance, and what experience they've had with finance, is that they may or may not want to have debt. And I think that it's a very simple equation, first of all. Yeah. Don't borrow money that you can't pay back. Yeah. Of course. However, money should be seen as a tool or a product. Yeah. It shouldn't be seen as a never-ending thing. Yeah. Because it isn't. And your relationship with it, the more you step back and saying, I'm just using money as I would use other supplies in my business. It's just a supply of something. Yeah.
As long as it's calculated the right way, I think that's what people find uncomfortable. It's all right. They can find out how much they can get lent, but it's like saying, right, if I can get a facility of $500,000 to go put into my business, it's like, what do I do with the 500? Well, you might not need the 500.
No.
You could probably do it with 150.
Yeah.
And obviously it's understanding and modelling it, or having someone do that for you.
Yeah. So money should be just seen as an accelerant.
Yes.
So what it does is it makes the future come forward.
Yeah.
Okay. Otherwise, save up and surplus.
And do it
yourself.
Yeah.
So if you're looking to borrow money in growth, you're doing it for a reason. So you're looking to go up to a higher level of something.
Yeah.
You're either growing your sales, you're growing your team, you're growing your reach. Mm-hmm. You might be going to a different area, for example, whether that's regional in a country or
Yeah.
across borders. And the money there is just to cover the costs to get you from here to there.
Yeah.
Now, ultimately, you're looking to borrow money to make money.
Yeah.
And that's a simple fact.
Yeah.
So A turns into B, and A plus B is where you're going, trying to get to. And in that concept, if people just simplify it like that and see, I need an X amount of money. Now, sometimes I don't know exactly how much they need. That doesn't mean to say they shouldn't apply.
Yeah.
But what they can also get mixed up is if they don't know how much they need, then they talk to a lender.
Yeah.
It's a bit, do you know what you're doing? And actually, if they are able to speak to lenders and they can identify them, they can speak to them, they can say to them, look, I'm formulating some ideas. I'm understanding I need a range of money. Now, I can be exact up to a certain point, but there are some variables.
Yeah.
But people use terms like contingency, what ifs, kind of extra. And if you use that scenario, 500,000, but you really only need 150, you could say to a lender, well, realistically, the hard facts is I know I need 150. However, I am going to be talking to my accountant in a bit more depth. And it's likely that it might need a bit more.
Yeah.
So can I borrow 150 now? And can we pre-agree that I could borrow another 150 or 250 in the future?
On the same terms, yeah.
Now, a lender will look at that and say, well, that's an intelligent way to do it, because you're more than thinking, I'm putting my money into a lottery ticket and hoping for the best. You're going, I'm going to go, this could go one way or another way, which is where in equity finance, it's a little bit different. But people are saying, I don't really know how it's going to go.
Yeah.
I need a bit more latitude. So it's more risk to the equity investor, because you're going to go, well, here's $1 million. I know you said you might want 500. Let's go with $1 million, because in my experience as an investor, things take twice as long and cost twice as much. So let's go with $1 million. Yes, my expectations are only more shares in the opportunity in the business, but I'm going to take that extra risk, because otherwise you could run out of funds. And that's what happens in early stage businesses that look to get equity investment, is they use the equity to get them going, but they've never been past that point before. So they don't know what they need when they've got there to grow. So if they get into the treadmill of continuously going for equity, there are only highly scalable businesses that can benefit from that. And the owner needs to realise they can own a lot less of a much bigger pie, which is absolutely fine. But if they go with the pre-concept is that $1 million is going to make me a billionaire, it never quite works out like that. And there's so many technology accelerators and people involved in various different kinds of, bio or even construction or accelerating new ways of science and these kinds of things, which are fantastic investments. But what the investors understand is that a lot of them are never going to succeed.
Yeah.
So what they're doing is they're backing on the opportunity that 1 in 20 would do fantastically.
And cut out the rest.
Cover
the rest.
Cover the rest, whereas 10 of them might just about break even.
Yeah.
5 of them might do quite well, but the rest will be absolute dead ducks. And just fail.
I remember because I follow some of the guys in the search fund space, right?
Yeah.
And that model I don't really agree with personally. Obviously, it's a good model in itself, but I think the stats coming out of search funders now is quite negative.
Okay.
Or they're not meeting their IRRs as much as they should do, or that they've pitched to investors.
Yeah. I don't consider myself to be an expert in search funding. I know it's a fairly small amount in the market space in terms of investment.
Yeah, so as you know, search funders are just alternative individuals doing a private equity sort of buy and build strategy.
Yeah.
In simple terms, and in this, it's enabling an employee or a serial operator to get funding behind them and go and give away loads of equity for
Yeah, well, this is the
run a
thing.
business.
It's about what you're prepared to give up.
Yeah.
So if you look at the search funder, the mindset is that so this could be something that's grown through high levels of professional capabilities.
Yeah.
They're made of a responsibility for a whole variety of people, tens, hundreds of people, big budgets of other people's money.
Yeah.
So what they're saying is you can bet on me because I'm a good bet, because I can look after people, I can grow sales, I can improve profits, and I'll make you money. And that's fair. That's fairly relevant. That's fair and relevant. And there are people that we are connected to that have done that sort of thing. So this whole search funding, entrepreneurship through acquisition kind of approach has some merit. I think the search funders that are very selective, and they only do a few a year, they're quite savvy. Is that what they do is they bring a whole group of advisors around it. They're saying, well, we're going to bring you your board, we're going to bring you your senior management, we're going to help you to make decisions that you may not have made in this circumstance, but we know how. So I think there's some merit in that. But what you're doing now, like you say, you're starting off and you're working for somebody else.
You're still working for a board of investors.
You are.
And I think the model itself works, and it's just a buy and build on.
Yeah.
It's just a corporate buy and build.
It is.
But I think the go-to percentage they give away is a lot. I know they're not bringing no capital; they bring equity into it themselves, but they're managing a big ship.
Yeah,
and they're giving away a lot of money at the end. Don't get me wrong; they still earn. If it all goes well, they still earn very well on the upside.
They do,
but
so let's just talk about numbers there. And they could be talking 20 to 30% they own. And the search fund owns the rest.
Yes.
As an example.
Yes. That's the go-to. That's the rough.
Yeah, it could be a bit more, it could be a bit less depending on the circumstances. So what they're saying is, look, I'm prepared to put 5 years of my life in, because you're going to sign up for at least 5
years. At least 5,
Yeah. And you're going to say, I'm going to put 5 years of my life and I'm going to make you as a search fund more money.
Yeah.
That's what I'm here to do. And on the next 5 years, I'm going to be a business owner, but in a smaller capacity.
Yeah.
But we're going to grow a bigger business because you're backing me, and I get that. So I'm going to have all that lovely experience and support. Fantastic. So it's about going through a high level apprenticeship.
Yes. Yeah.
Yeah. It's about going, I know a lot. It's a bit different to an apprenticeship starting from
I think we said that, yeah.
But somebody's saying, I'm going here, I'm going through a structured approach. I'm going to learn along the way. I'm going to build out my experience and expertise, and I'm going to have successes, and I'm going to have something to talk to.
Yeah.
That time between 5 o'clock and 9 o'clock.
Yes.
Overnight, because I've got issues and this has happened and that's happened. I need somebody to just have me back. And I think there's some merit in that. I do. And I think the only correlation alternative to that, like talk about earlier about startups, is about when people start their own business or they buy a franchise.
Yeah.
Because what you do with a franchise, it's not the same in terms of they own shares in your business, but you're paying them a monthly fee all the time, and you can't give out that monthly fee. That's forever.
Mm-hmm.
And that's because you're operating on their operating system, you've got their brand, you've got their etc. how to do things. So I think the search funds and entrepreneurship through acquisition is going to become more and more prevalent.
I think it is. I think it's massively growing anyway.
Especially where you get more and more people. So if you look at the advances, so what are the pressures on this? Well, the advances on technology is in professional services, consultants, wealth management, advisory, accountancy, different types of accountancy, bigger accountancy practices, all these kind of corporate finance kind of entities where you've got people been working on other people's businesses but never own their own.
Yeah.
Okay. They're being squeezed out of their roles because some of what they do can be done a lot faster with AI. So it means that people are saying, well, I don't necessarily have to employ somebody on a 6-figure salary. I could probably employ 2 or 3 people on a 5-figure salary and get 10 times the output. Not necessarily it's the same quality, of course, to some degree, but it means I can compete with other people in my industry who are doing exactly the same. Mm-hmm. So those people coming out having earned to those salaries, and now kind of like their expectations are higher. than somebody starting or somebody buying a business
Yeah.
with a bit of their own money and a bit of somebody else's money, like in debt finance.
Yeah. I think done correctly and having the right, it's all about any business, it's all about having the right team around you, which is it's one of the most key factors, but it's one of the most hardest people to find, especially when you've never done it before.
Yeah.
The model works, but I just don't like the go-to split of it. Like you said, 20-30%, and you do all the runnings. I know you don't put in capital,
Yeah.
but it should change over time, in my opinion. But it is a traditional model from, I think it stems back from like the 80s, doesn't it? The search fund model originally from America, and it's.
I think if you flip it over into the alternatives where you can get equity investment.
Yeah.
So if you've got a business model where you've got a gap, you're buying a business, let's say a £10 million business, revenues, making £1 million profits, and the sales price is, let's just be friendly, and say £3 million. So we'll say £3 million, and it might be a bit too tight to do that all with debt.
Yeah.
And the debt provider says, realistically, if we're going to lend you, say, 2 million, and we want you to get 1 million, and you go, hang on a minute, I've got 50k.
Which happens a lot.
It happens a lot. So in that circumstance, you're looking for an equity investor, and the equity investor is going to put in, so we're talking 950k, for example, in this circumstance. And the value of the business was 3 million. You could say, well, I want more than 950 divided by 3 because I'm taking all the financial risk here. I'm backing you on this one, and you've convinced me. But if this is your first go, it may not be your first go, but if this is your first go, we've got to talk about how that's going to work. And I think the issue is with that is that when people are getting equity investment there, they have to choose in the same way as search fund. You've got to choose the right equity investor.
Yeah.
Because you need to bring somebody that brings more than money. And they've got contacts. Can they help you to grow? Can they help you to grow the business? Not necessarily day to day, but can they open doors?
Yeah.
Can they steer you in the right direction kind of approach? And although they may not be having 70, 80% of the business, it might still only be less than 50% of the business. It might be more than 20%. It might be, depending on circumstances, it might be somewhere between 20 and 35%, for example. You've always got that in your background. At some point, you've got to give them an exit.
Yeah.
So your mindset has to.
It's pretty forced then, and it's putting you into a corner. But as it's your first one, it's probably a good thing.
Yeah, and giving somebody a third of the business.
Yeah.
At the end.
Yeah.
When you turn 3 million value into 10 million,
so
it's 3 times. They get 3 times their return. It's not bad. Show. What I'd love to get is 5 or 10 if they can. So that's why sometimes it's hard to get equity investment to fill that gap because they're trying to figure out what am I going to get at the end? When are you going to exit?
Well, that's what I mean. It's just forced, but it's a good force because at that point you need to go through that, and do it, and then after that, you then build relationships along the way. You come in front of other lenders, other types, so you can then have the opportunity to do it yourself as well. And I think we might have to stop it there because there's a big noise in the background of someone deciding to cut their grass or something like that. So but no, Gary, it's been a pleasure, mate. I really
thank you for the privilege of being first. Also for you taking the time out to spend some time. It's nice to talk about these opportunities and activities. And if anybody gains anything from this, it's a kind of like, does it answer a few questions?
Well,
does it help you move a little bit?
Well, that was always been my aim for the Acquisition Collective. That's the whole event, is to put it on for people to come together. One, to obviously network and meet new people. But if you're not scared, but if you've got lots of questions and you're unsure, then that's what the room is for as well.
Yeah.
And that's why in every event we get more and more now is guys and gals that have come and they've gone, I don't know about this, I'm thinking about it. And it's good, it's really good to see. Like from the event, I think I've taken on an intern who's come and gone because I don't know where he's gone at the minute. There's 2 other guys that I've sort of taken under my wing. One's actually looking to do a search fund because of his age and his inexperience, and I'm going to advise him on it.
Yeah.
And then there's been a couple of guys who have come to the event who have started as an employee in their own fields who've now jacked that in and gone solo.
Yeah.
So that's really good.
Yeah, absolutely.
And it's good. Like a room that I just rated because I got challenged by the wife because I was moaning at her. I mean, it's pretty cool. And the podcast is here because I want to do just one-on-ones with people to help.
I'm looking forward to
people learn
a lot more.
You know what I mean?
There's so much to learn. There are people out there that are experts.
Yeah.
They've got multiple.
And I'm no expert. Don't get me wrong, like, I've done 6 acquisitions and I've exited a few.
That's more than me.
But I'm not, I'm always open to learning. You know, like I love to read and learn people's perspective, and this is the best way to do that. And if it helps people, it helps people. Well, if it doesn't, I'm having fun doing it. So,
absolutely.
Yeah.
No, I do agree. I think it's been great, and I think that the more that you've got more people coming through, it builds up the collateral for people to learn from through the eyes and ears of other people, because you don't know always the question you wanted to ask, and you might get an answer to a question you hadn't thought of.
And thing is, with all these people, I used to do it before. You just ask Google too much, and you keep asking Google, and then it's AI, and then it's a bit like, well, let's get some professionals in the setting like this, and just I can ask you the dumb questions, and then we can help. It's got to be at least one person that gets helped. Sure,
Nate.
You know. So, but it's good. It's good fun.
No, I do.
But no, thank you very much, mate. It's great stuff. Thank you.